Welcome to a new segment and welcome, Niclas.
Thank you.
In this segment, we have a very, very cool topic, in my opinion, and that's algo trading. One is, how does it work? Why is it hard to find? And the third thing is, why is it hard to implement? And to give you a little bit of backdrop, I think I have programmed 100 plus around there. Different type of algos, tested, back-tested, everything. And every time I had great hopes. It was been exciting to work with and to back-test it. Even my master's thesis was a back-tested algo strategy. However, one thing is to work with the numbers, which are hard enough in itself. Another thing is to find that, to come up with the strategy. And third is to implement it. It's hard all the ways, in my opinion. So it's a big question, but how does it all work?
There's a lot to unpack in all that. And I think, if we start from the top, where do you get an idea from what an algo might look like? So it's two directions you can take. So either you basically sit and have a theoretical idea that this ought to work in a market. For example, you could say, if we take arbitrage as an example, if I find these price differences, they're big enough, and I can execute on them, I will make money. That's sort of a theoretical idea. And people do that, and we can get back to the details of it. The second is to go the other way around, that you actually have some experience on markets. Basically, sometimes it could be staring into a trading screen for many months. And I've seen this pattern. Can we encode this pattern? Is it a reliable pattern? So you basically go from experience and then trying to make an algo out of it. And both are viable. I think the experience type of pattern is maybe more fun and more interesting. But both are really used, and we've sort of combined both. It started as a theoretical idea, the idea of volatility trading. So that's the idea, right? But once you have
But what would that? How does that idea look like? How does the idea of volatility look like? Take us through it. Not necessarily the secret sauce here, but the basis of the idea.
Yeah. So. And that started really, and this started as a theoretical idea from us. But it's just a very simple observation that if you rebalance, under many conditions, when you rebalance a portfolio in a market you believe in, you will make money on that rebalancing versus buy and hold. And I will take you an example. So let's say you have a portfolio of cash and Bitcoin. You have $100 worth of cash, you have $100 worth of Bitcoin. And then you consider that portfolio to be buy and hold. You're not going to change anything. And you consider a situation where Bitcoin goes down 50%. So at the bottom, let's say it goes down 50%. You only have $150 worth of assets. And then it goes back up to where it started. So you're back where you started. You $100 in Bitcoin, $100 of cash. You haven't earned anything. So the basic idea was that, but if you have a market like this and you rebalance, you can actually make something. So we start now with $100 in Bitcoin, $100 in cash. Bitcoin goes down 50%. So you sit here with $50 worth of Bitcoin, $100 of cash. You rebalance to equal weight again. So you take $25 of cash and buy Bitcoin. So you have $75 worth of Bitcoin, $75 worth of cash. And then Bitcoin goes back up again. That means you have now $150 worth of Bitcoin and $75 worth of cash. So you have $225. So by rebalancing, you have made $25. That's the basic idea. Yeah. That's the theoretical idea. And you think in terms of, obviously, if you have a sideways trading market, that's in some sense ideal for this type of strategy. Just lots of vol, back and up and down. But that's how it started. But then the question is, how do you implement it? What is the fee structure? Because it will cost you something to trade. Every time you execute, you're going to give the exchange a fee and so on. But yeah, that simple idea was actually the basis for the
Very well put, very easily explained. My head started to go everywhere there, because the next step would be in search of, because that's the idea.
Yeah.
And now we go to like form out, put together something. And my idea, let's take, let's say we use some volatility band, and if the move is one standard deviation down, we buy, and one standard deviation up, we rebalance on the other side. And then you would use volatility and standard deviation as the rebalancing factor. But then again, how would you then manage the volatility of volatility? So in the sideways market, then you would have one volatility, and when it explodes up or down, or does go out of the sideways market, you would enter into a new set of standard deviation. How would you protect yourself? How would you?
It's depending on where you do the rebalancing. And it's very interesting. What you just mentioned now is another trade idea, right? Which has to do with mean reversion. So you observe that if the market tanks, it usually always overreacts in crypto. If the market tanks, let's say 50%, I should go in and buy. If it rallies, because you're then betting on mean reversion. And it's all about at what level do you rebalance your portfolio. So in the example I gave, if let's say you take the rebalancing bands on the upside or downside too wide, you're not going to do a single trade, right? 1,000%, 100% down, or 10,000% up, I'm going to rebalance. It's going to be a buy and hold portfolio. But then on the other extreme, you can do, okay, if it goes up 1 basis points or down, I rebalance. You're going to a lot of trades and you're going to pay a lot in fees. So that's where the backtesting come in. So you start with a hypothesis. Okay, I suspect this pattern might exist. And then, okay, let's implement it in a backtesting and see how would it have done. And then you should do it carefully. You should take transaction fees into account. And there you see, okay, there you can start to see, okay, that maybe I should choose this kind of level on the band. And of course, this is somewhat deceptive. That's why you need, ideally, a lot of backtesting data, because you don't want what is called snooping bias, that you sort of fit your parameters that no matter what, it's going to look good. Look at this, the past 5 years. But you have to be sort of rigorous about it. And ideally, you set the parameters and then you test it on many other cryptocurrencies or other instruments. You see that broadly, it's positive expected value. So it's a bit of a craft there. And the example you did, so a simple model that might be robust is you just look at the long term, you don't change the rebalancing bands. A more sophisticated model, what you're just describing, is that then you need a model that detects, okay, the volatility regime has changed. I should change the bands, and the algo can adjust for that automatically. That's an even more sophisticated way of doing it. But that also has its drawbacks. But if you do it right, you will make even more money there. But it's harder, right? Because you need to be confident that, has the volatility regime really changed? And for how long will that last? And so on. So it's that eternal refinement, and you can never, ever be sure that parameterization is correct. Over time, you will see, do you make money or not? Does it
That's the pudding.
The
proof is in the pudding. Eating of the pudding. So to speak. Back when I was working in a quantitative fund, the rule of thumb there was to test stuff on 20,000 data points. And then implement it and like fit it and then move it over to an untested environment.
Out of sample.
Exactly. So that would be, in other terms, that if you were to test at a time frame from 2000s to 2010, you see it works, and then you go from 2011 till today, which would be. But then again, then you have the regimes, and then you can test on other assets and stuff like that. What are the rules of thumbs to follow for the backtesting work and fitting and to I know there's a lot of pitfalls, but is there something to hold on to as a rule of thumbs?
No, I think what you just said is very sound. Like you should have an auto sample period, and you really, if you do it correct, you can only do it once, right? Because let's say you tried up to 2010, and then okay, this was the outcome. I didn't like the outcome. Let's recalibrate on the first place. Then you're already deceiving yourself to some extent. That's one thing, auto sample, but it should ideally work on several instruments. So let's say if you have a single asset type of strategy that should work for a single asset, you can test it on many different, and you see, for a large set of assets, it works, it has a positive expected value. But you can also be sloppy about it in some sense that if you run, and that's a good thing with crypto, you can do small trades, right? Or you can observe the liquidity. So let's say Bitcoin has a lot of liquidity. We saw it before, like on Binance, $8 billion traded in the beginning of the day.
Yeah.
And when the liquidity is good, you can feel comforted that your small trading will not impact the data,
environment.
The data. Yeah. Hence, if you take that data, it's probably relevant for your trading. So what you can do, what you can do is to run a lot of algos on small money and see how it works out. That's the quick and dirty, and sometimes that's a good way. I don't know. Let's see how it behaves. You just code it. You create a sub account, put in $100, $1,000, and you start from there. And the more comfortable, or you get more like indications that it might be working, you might add capital. So that's also one way. Just throw yourself in and tweak and tinker and see how it behaves. And one interesting thing is that when you have, so you can look at your algo and say, these kind of environments would be troublesome for my algo. Like the example you said, or if we're rebalancing, for example. If you're rebalancing, what happens if it rallies really hard up all the time for a long period of time, or really hard down?
Yeah.
Because then you won't have the volatility swings, and that has occurred from time to time in the market. And one good thing is that, okay, then you can backtest and see how it behaves. But then if you put it on small money and just let it run for a period of time, you might enter those territories. And how did it behave then versus what your backtesting said it would? So you get, like tinkering and looking like this, you can piece things together. One simple algo that has worked, it's a bit simplistic, is the long-term moving average of an asset versus the short-term moving average. And the idea is that when the short-term moving average is crossing the long-term moving average, that's a buy signal, and in reverse a sell signal. Most markets are more efficient than that, but sometimes it works in certain markets. So anything goes really. Is there a pattern that I suspect works in the market? And then you can implement it and experiment with it, basically, on real money.
And the moving average example is a good example of because that would catch the long trends, right? If something catches on and it just goes and goes and goes and goes. And there's a saying in finance: big money is made on big moves.
Yeah.
and that's a trend following a strategy, right?
Yeah.
But the moving average strategy wouldn't work in a choppy market.
No.
Like the contrary.
It would always be you would most likely lose because you would be buying and then it goes, just after you buy, it
goes
just
down
whipsaws and on and off. Yeah.
And that would be like an example of why it's hard, because then you would need some either stay out of the market or just live through it. Yeah. And then comes the money management, the risk management of the whole cake.
Yeah. And it all has to be balanced with how much are you willing to pay in transaction fees and so on. But that's on one time scale. But you also have algo traders moving from, if you go to really small time scales, like the arbitrage or market making, it's a different game. It's about small edges. It's about how well can you execute. You can detect price differences, right? But can you do it in an efficient enough way that you actually make the money from a theoretical point of view. So you have to have quick execution, a lot of good logistics, maybe shuffling from one exchange to another. The algo needs to be precise, and that's a different type of game. Because anyone would realize if there are price differences, like the idea of how you make money there is sort of obvious, but it's all in the detail. How do you execute on it? The difficulty is execution. So you have all these, depending on what time scale and what type of trading you do, you have different difficulties. And that's what's so fascinating. So you can basically, what style do you like? And all styles have their own challenges, and competition is picking up. So it's not easy.
It's not easy picking. No, absolutely not. And in terms of styles, what are you guys doing in Hilbert Group, in your hedge funds?
We came from, let's say, not high frequency trading. The trading we've done, the algo trading that we're running in 3 funds, maybe we are sort of looking for changes in the market every minute, order of magnitude minute, not more often than that. So I would say it's intermediary frequency.
So that's you look for changes every minute, so that doesn't mean a trade every minute.
No, because even if there is a change, the change might not be big enough for us to want to execute on it. But we look for big enough trades, let's say order of magnitude once a minute.
Interesting. And what does that look like in terms of number of trades during a day or month or whatever period?
It's been, order of magnitude maybe 10,000 a month. But depending on volatility, the more volatile that type of trading, the more trades you will do. But if we look at some historical, average, it might be between 10 and 20,000 trades a month for a given fund.
Yeah, that's quite a lot, though.
Yeah, but it's in algo trading land. It's sort of not really. We know people who make 100,000 trades a day, and so on. And there are some who are doing 1 million trades a day. But on paper, like if you were to print all the trades, it's 20,000 trades is still
a long
list.
Paper. And then, but that begs the question, really, in a world where you can choose whatever.
Yeah.
How did you guys land on this niche or this?
I think it's just the idea of volatility trading that Magnus, the other co-founder, was working at the time. It can be applied. The fundamental question we asked was, if you have a perfect market, so no inefficiencies, what is the most you can squeeze out of it? And the answer is the volatility trading. And it's sort of proportional to the volatility of that market squared. And there's some factors, but just to illustrate the principle. So if you have S&P, that's how we started. Annualized volatility, let's say 20% squared, that's 4%. So the most you can squeeze out theoretically from a market like that, assuming it's perfectly efficient. I think S&P is close to efficient.
Yeah.
That's 4% on top of that in terms of vol trading. But then crypto came along and had an annualized vol of 200%.
Will that be 4% in addition to the?
In addition
to the
but
long
it's
hold,
a factor. So it's not really. There's a factor that depends on correlation, and it's divided by 2 as well. So, but in theory, order of magnitude 1-ish. If you take all the factors into account, on top of it, that's the most you can squeeze out. If it's perfectly efficient and you can squeeze it out by vol trading.
Yeah.
But you will have drawdowns, right? And some of those drawdowns will last for a long time. But, if you continue to do this, that's on average what you're going to squeeze out of a market like this.
And then we're moving really to the classical 60-40 portfolio with the bonds and the index and the stocks, and whereas actually you rebalance, but on a calendar scheme, not like a volatility. It's just time to rebalance.
Yeah. Regardless of how the market have moved.
Yeah.
Okay, it's time to rebalance.
Reset to the default setting.
Yeah.
But the effects of it or the consequences of the rebalancing is exactly what you said with the In the example that you came with in the beginning.
Absolutely. So you will get some harvesting of volatility earnings in that simple example you gave. Because if you believe in the, let's say, mean reverting principle of the market, that so let's say equity has underperformed bonds, if you were to rebalance back to that weight, you would sell some bond and buy equity up to 60% again. And that's vol, but on a different frequency. Instead of vol harvesting minute resolution, you vol harvest with a frequency of 1 month. But it's the same principle.
Yeah.
Anyway.
Thank you.